Brad Williams, Frugal Finance. How about we talk about mutual funds? Here it is, it's 2025, and we're in an era where the talking heads are always pushing what are called exchange-traded funds. Well, long ago, an investment type was introduced under the phrase mutual funds. Then, 20 years ago, exchange-traded funds were introduced, and now, over the last 8 to 10 years, a huge switch away from mutual funds to exchange-traded funds. Why? I'll explain why. Mutual fund is an open-ended investment company or fund. An open-ended fund is one of three basic types of investment companies. The other two types of investment companies are closed-end funds and unit investment trusts. Exchange-traded funds are generally also structured as open-ended funds, but can be structured as UIT as well. So an exchange-traded fund kind of fits within the mutual fund classification, but is recognized as a standalone product. A mutual fund continuously pools money from many investors and invests the money in stocks, bonds, money market instruments, and other securities, or even cash. Here are some of the traditional and distinguishing characteristics of mutual funds. Mutual funds generally sell and purchase their shares on a continuous basis, although some funds will stop selling when, for example, they reach a certain level of assets under management. Long ago, before ETFs were popular, there were some very popular mutual funds that grew to enormous levels, and the money managers couldn't manage the inflow. So they stopped money inflows strictly because their strategy, particularly growth stocks. Well, you can only go so far with growth, and you can only put so much money into a fund before you start. When you cannibalize your own accounts by growing too big, and your overall return will suffer. So you put a cap on the size of your fund. Investors purchase shares in the mutual fund from the fund itself or through a broker. Investors can purchase shares from other investors on the secondary market, such as the New York Stock Exchange or NASDAQ. The price that investors pay for mutual fund shares is the fund's current net asset value per share plus any fees that the fund may charge purchase, such as charge or look. All right, so here is the paradox. Go back 10 years ago. You look at Warren Buffett. You look at his portfolio of publicly traded stocks. You take each one of those shares and you compute its value, and you'll come up with a number. Then you look at his particular Berkshire Hathaway, and it's trading above the value of the portfolio of stocks. In other words, on the normal market, let's say this portfolio had a value of $100. Let's say it's 30 different stocks that are in Berkshire Hathaway. But Berkshire Hathaway is selling for 110. Why? Do you understand why? Or turn it around. Let's say you have a crappy money manager who has bought some not well-performing stocks. Again, we'll use that $100 value. In other words, you take a look at the 20 stocks alone. Then you look at the portfolio of the money manager who has never performed better than the market, and that portfolio is selling for $95. That would be the net asset value. Why? Explain to me why that happens. I have the answer, but I'm going to let you provide your opinion as to why this happens. Mutual fund shares are redeemable. This means that when mutual fund investors want to sell their fund shares, they sell them back to the fund or to a broker acting for the fund. Keep in mind, you as an individual could go out, you can look at the portfolio of a top-rated mutual fund, and you can buy those stocks on your own. There's no secret there. That's what people do with Berkshire Hathaway. They just look and they see, well, it's Geico and See's Candy and Dairy Queen and WD-40 and the railroad company and so many others. You can go out and buy them yourself. Or you can pay a money manager, and that's what happens here. There are sizable fees in mutual funds. So you, as a consumer, are not getting the full value if you are using a money manager who's managing this mutual fund. Keep that in mind. If you're losing 1% and it's going to cover the expenses of the money manager, If you're a busy individual, you don't understand this stuff, then you don't mind paying that money manager. On the other hand, the reason ETFs are so popular, my next video will be on ETFs, and I'll explain the difference. There are many varieties of mutual funds. Oh, there must be 20,000 different mutual funds out there. You have stock funds, you have bond funds, you have money market funds, you have option funds, you have leverage funds, you have reverse negative, you have you have some very creative, over the top. If you can come up with an idea in terms of Wall Street, it's a product. It's just like when you walk into a Walmart or a Target or a Costco, you have all those products. They're endless, and then they're always changing. Well, Wall Street's not any different. They're just selling the latest and greatest. Whatever the talking heads are pushing, or whatever Wall Street is pushing to the talking heads, you, as the investor, shouldn't listen to the hype. You need to do the due diligence. That means look at a track record of at least 5 to 10 years on that mutual fund, on that ETF, on anything. Don't be a sucker and fall into the hype. Key here, fees and expenses. This is what's critical. Long term, it could have a sizable impact on the compounding effect of this mutual fund. For more information, take a look at mutual funds, ETFs guide. That'll be next. And then read all the funds available information. You're going, I don't have time for this. Find the time. I know you're thinking, I have more important things to do. I run a business, so on and so forth. Well, you need to educate yourself to get a better grasp of the complexity of investing. Leave your comments, any tips, any helpful guides. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.